I'm so excited today. It's hard to wait this 1 minute. All the 7 before this, I had no problems waiting the full minute to start. But today is different. Today is exciting. Yeah.
What's got you so excited today, Ken?
What's that?
What's got you so excited today?
I think the fact that literally today we have interim final rules coming out from the SBA. So that's what makes this so exciting for me, Sarah, that I am on the edge of my seat waiting to hear what you have to say. So we're going to get started. Looks like we'll have maybe some more people jumping in based on past attendance. So we'll just go ahead and start with the housekeeping introduction. So welcome. My name is Tim Hilligus. I am a shareholder from Clayton and McCurvey, and along with one of my fellow shareholders, Sarah Russell, and Senior Manager Ben Smith. This is our 8th Payroll Protection Program loan live video. This is new to us. Many of you may have been familiar with the CFO roundtables we've hosted over the years, and I was lucky enough to host those, I think, for almost 17 years. My first 17 years at Clayton and McCurvey. Enjoyed the interaction. A little bit different here. I can only see some of you. I'm kidding. I can't see any of you, but I know a lot of you are thinking, oh, great, can you really see me or not see me? But I cannot see anything you're doing. So rest assured, if you're in your jammies, I'm not that concerned about it. But this is, as I said, our 8th live video. We have more to cover today. Sarah was out of town. I was out of town. And this morning, we have the most recent interim final rule. So those of you who have been with us since the beginning, on March 27th, the president signed the CARES Act. We've had 2 legal changes to the CARES Act since that was enacted. We have had 48 frequently asked questions and now 19 interim final rules. And I'm sure there will be more because smart people like us and like yourselves read this stuff and have more questions, and we've continued to have questions, which gets to my next housekeeping item, and that is, if you could please take a look. We've got an open question section, and we will answer your questions live to the best of our ability. If we can interject them in the presentation, great. If not, we expect to probably have a little bit of time towards the end today, which is something we've done the last 2 live videos. We've gone to 4:15, and so I'm going to ask your permission again by proxy, which means I'm doing it anyhow. We're going to probably go till 4:15 today to kind of get through everybody's questions as much as possible. So please go ahead and type in your questions. And the other thing, you'll notice there's a really neat thing within those questions. There's a little arrow or a little triangle, and that's called upvoting. If you see a question that relates to you or that is important to you, go ahead and click on that, and it will give us a count. And whether Sarah's presenting and Ben and I are reviewing questions or some other combination, we're able to sort those questions by the upvotes and by the importance. So I think that's about it. I'm going to break in about 3:55 for kind of a last housekeeping discussion on where we might go from here. But literally as we speak today, new information was coming out, new applications, new instructions. So I'm going to turn it over to my partner, Sarah Russell.
Thanks, Tim. Before we get into the discussion on the PPP information that's been issued recently, I did want to touch base really quickly on a couple of things that have also come up this week. On Monday, the SBA reopened the Economic Injury Disaster Loan and the EIDL grant programs. So if you had originally planned on applying for one of those loans or grants and it was closed before you got your application approved, those programs were just reopened again. I'm not sure how much money is available out there and how quickly it will go, but wanted to make sure everybody was aware that those programs are back open. Sort of as a refresher, the EIDL grants are available up to $10,000, and that is strict grant money. And it's limited to $1,000 per employee. So if you're a small business that has 5 employees, you could get a maximum grant of $5,000. The EIDL loans have more requirements than the PPP, and there's personal guarantees. They're a little bit more restrictive, and you can't use those funds for the same thing that you use PPP funds for. But just wanted to mention those grants are back open. The other program that's coming soon is the Main Street Lending Program. They just got the portal open for the lenders this week, and we expect that the borrower portal will be going online sometime later this week or possibly next week. So those are two programs, access to other funding that you may be interested in. We're not doing any webinars on this information. We're not going to talk about these programs today. Just know that they're out there, and if you talk to your CPA or your banker if you're interested in these types of programs, and they can probably point you in the right direction there. Summary through Sunday, June 12th, I guess that was last Friday. The loan approved dollars is $512 billion. So it's gone up only $1 billion since last week. Same statistics that we talked about last week, still just under 30,000 loans, over $2 million. And the average loan size is $112,000 now, which is a decrease from $114,000 that we talked about last week. Still slow going on the new net approved dollars. It seems like most small businesses that have wanted access to the funds have gotten the access, and it's just the new smaller loans that are still trickling in here. So we're going to talk about the new guidance that has come out. They've given us new loan applications, which we'll talk about, but just as a quick refresher, in case there were people that were not on last week when we talked about the Paycheck Protection Flexibility Act, give a refresher as to what was included in that act. It extended the covered period from 8 weeks to 24 weeks after the date of origination, which is the date you received disbursement. If you applied before June 5th, you can elect to use the original 8-week covered period if you so chose. It also reduces the amount required to be spent on payroll from 75% to 60%. And it amends the terms of the loan to be a minimum of 5 years from the 2-year maturity that was originally imposed by.
All right, well, I am guessing we lost Sarah, and we'll give her a second to come back in, but maybe in the meantime, while Sarah is trying to reconnect, I'll take over, and I'm gonna make things up. I'm kidding. I don't have Sarah's slides, but I think Ben and I can go through a couple of the key questions that have already come up, and I got a little bit more of information. So let me give her a second to check back in. Let's go through a couple real quick things that are out there that should be on your radar that are related to the PPP program. We still don't have any final insight. So Sarah, I see you're back, so I kind of took over quickly. Let me just finish my thought and we'll get right back into your slide if that's okay.
Yeah, just let me know where I cut out.
All right, perfect. It was right back at where I said I'm going to turn it over to Sarah Russell.
Awesome.
No. But three things I want to make sure people understand is there's still a tax issue related to the PPP loan program. There's an accounting issues related to the PPP program. And these could straddle different years. You could ultimately have expenses occur in 2020, forgiveness occur in 2021. You could have all of it happen in the same year. But remember last week we talked a little bit, very briefly, about this term analogize, which is tough to say, and I wish that someone had thought of another word. I'm going to think of another word for that versus analogize, but it lets you basically take accounting rules that make sense that maybe not applicable or may not have a specific situation under U.S. generally accepted accounting principles, and you can use international accounting standards or perhaps not-for-profit accounting. I'm not going to get into that right now. Talk about that a little bit later. But the last thing I want to make sure you're aware of is there are two bills in Congress, one in the Senate, one in the House, called the Small Business Expense Protection Act. And those will be important. Those are those things we talked about last week where, as it stands right now, the Internal Revenue Service is going to deny your ability to deduct any of the expenses that you incur to utilize loan forgiveness. What that means from a math perspective, C corporations pay tax at 21% plus have a state rate. So at a minimum, you're going to lose 21% of the benefit of that amount you get forgiven. If you're a flow-through or a self-employed individual, very likely you're at a 29.6% rate with the flow-through deduction. Maybe you're in a 37% bracket, depending on how your income flows through to you, but the impact could be pretty substantial. So kind of just to throw another monkey wrench in there while Sarah was locked out, just want to make sure you understand that reaching out to your Congress people will be important to try to get the benefit of that. And just to give you some ideas, Sarah had talked before, a lot of very powerful senators have said this was our intent. The problem is nothing has happened since the middle of May. And so these are just sitting in their respective committees, the Ways and Means Committee and the Finance Committee. So the important phone call or email to make if you're trying to maximize the total benefit for the loan forgiveness. So Sarah, I think you might have been like second bullet point on your slide.
Okay. So just going back to the refresher on the PPPFA, it reduces the amount required to be spent on payroll from 75 to 60%. It amends the terms of the loan to be a minimum of 5 years from the 2-year maturity originally imposed. That's only applicable for loans approved on or after June 5th. However, the rules are clear that lenders and borrowers can mutually agree to extend the terms 5 years if they so choose. I'll talk about that when we get into some of the new guidance a little bit. There's a new exemption related to the FTE reduction if the business is able to demonstrate an inability to return to the same level of business activity. And it allows for loan recipients to benefit from the payroll tax deferment included in the CARES Act, even if the loan is forgiven. So those are just a couple of high-level refreshers that were included in the act that we talked about last week. I wanted to sort of start with that refresher before we get into some of the details of the loan forgiveness application. Again, just in case there are people on here today that weren't able to join us last week. So the updates that have happened since last week, we've gotten 3 new IFRs since last week to help adjust the PPPFA. The first 2 IFRs revised the first interim final rule, and the third IFR revises the third and sixth interim final rule. And really, what these changes are just implements key changes such as loan maturity, deferral of loan payments, and forgiveness provisions, the covered period, in that sort of stuff. So if you looked at the first interim final rule, there was a lot of legislative guidance in there that implemented the CARES Act that came with all of the stipulations, or imposed certain stipulations that were included in the implementation. So these IFRs are essentially implementing the PPPFA into those interim rules that had been issued. I talked a little bit about the loan maturity issue. I think that there's a big thing to highlight here, and that's that, for borrowers that got their loan before June 5th, 2020, the way the timing of everything works out, it's possible at the end there could be a balloon payment if they continue with this 2-year maturity. And the reason I say that is if you're a borrower that takes advantage of the extended 24-week period, the covered period to 24 weeks now, the guidance that's been issued has made it clear that you have 10 months from the end of your covered period to apply for loan forgiveness. So if you take the full 24 weeks, you apply for loan forgiveness in 10 months later, and then the bank has 60 days. We've talked about this in previous webinars. The bank has 60 days to approve your loan forgiveness application and send it to the SBA. And then the SBA has another 150 days to make their determination on ultimate loan forgiveness and remit funds to the bank. And the date that you are allowed to defer your payments to is the day on which your bank receives those funds from the SBA. So if you look at 24 weeks plus 10 months plus 210 days, if everybody took the maximum amount of time, a borrower would essentially have 48 days left to repay that loan on a 2-year maturity. Now, practically speaking, do I think it's going to take everybody a maximum amount of time? No, probably not. However, there probably will be instances in which that is the case. And there could even be instances where borrowers look at it and say, I am going to wait the full 10 months to apply for loan forgiveness so that I can delay the timing of when I have to pay this back. But I think that cash flow analysis and really looking at how that will impact your financial statements is important and should not be overlooked. We also, the interim final rules also clarified, previously we were concerned that the PPFA imposed a cliff rule regarding 60% needs to be spent on payroll in order to be eligible for forgiveness. The interim final rules have clarified and said that wasn't the intent. You will still receive proportional reductions in forgiveness for amounts used less than 60%. And essentially goes through an example and says, if you have a $100,000 loan and you only used 50% for payroll, you take or $50,000 for payroll, you would take $50,000, divide by 0.6, and that would be the maximum amount of loan forgiveness that you would be able to achieve. The 18th interim final rule, so there was two IFRs that revised the first interim final rule, the 17th and 18th IFRs. And the 18th final rule essentially relaxed guidelines related to applicants who were convicted of a felony. The guidance previously issued said if you were convicted, if a 20% or more equity owner had been convicted of a felony within the last 5 years, they were not eligible to apply for a PPP loan. This new guidance has relaxed that and said if you were convicted of a felony within the last year, you are not eligible for the PPP program. And if you were convicted of a felony within the last 5 years for fraud, embezzlement, false statement in a loan application, or an application for federal assistance or bribery, then you are also not eligible. So they really streamlined or qualified who can, who's subject to that 5-year timeline if you have been convicted of a felony, to include more white collar crimes. Sort of the intent is to ensure that people who are have been convicted of embezzlement or bribery or fraud aren't also fraudulently applying for the PPP loan. We have also gotten revised borrower application form. So if you haven't applied for a PPP loan yet, you will use the new revised application form. And really, this application form just revises some of the certifications and covered period language. It also makes it clear in the application form that at least 60% needs to be used on payroll in order to be eligible for forgiveness, or that your forgiveness will be limited. So there wasn't much changed on the application form other than some of the language in there. We also received a new easy loan forgiveness application form, which is new and a little bit more of a streamlined application, which I'll let Tim talk about in a minute. And then we'll go into details on the revised original loan forgiveness application. So Tim, I'm going to let you talk a little bit about the easy application.
Yeah, the easy application. I don't know, easy doesn't seem like the easy. We all probably grew up with the 1040 easy thought, a 1-page green form you got from the library, filled out with pencil, and, took care of it. This is a little less easy, but let's just briefly touch on this. I think the key thing to understand for this application is it limits, of course, hence the form easy. They're going to limit the borrowers who are eligible to use this. The primary use of this is going to be for self-employed individuals or sole proprietors filing Schedule C who got guidance in like the second week of the PPP loan application process. So what they've said is, hey, if you're the only person that you submitted a loan application for, and you're the only person that you're going to seek out forgiveness for, you're one of the companies that can qualify to use the 1040 easy, the Payroll Protection Program Forgiveness Form Easy, which is Form 3508 Easy. So if you don't have any employees, it's just yourself. You submitted your Schedule C with your application. You're the primary beneficiary of this. They do open the door a little bit. And so if you had a payroll reduction or salary reductions that were no greater than 25% in your workforce during the first quarter as compared to the first quarter of 2020 through your covered period, and you did not have a reduction in workforce that you could control, meaning you offered people their jobs back and they declined, or you were unable to find a qualified person to replace a person. So if you fall in that less than 25% reduction in payroll and do not have a reduction in full-time equivalents, there's a good chance you can fill out this EZ form. It's 2 pages or 3 pages with about 4 pages of instructions. And the final category is similar to the second category, which is no reductions in compensation. By that, I mean your hourly pay rate or salaried wage individuals, no reduction in compensation greater than 25%. And you were unable to maintain, and they use this term specifically, the business activity that you were incurring before the COVID outbreak. So if you look through the period of February 15th, 2020, what was the business activity that you incurred? If you were unable to achieve that level of business activity, then you would be eligible to apply or use this application, which essentially opines that your full-time equivalents reductions meet an exception. Okay, so they meet an exception. You did not reduce salaries more than 25%. So you meet those exceptions and you're able to use this form. The one thing I don't like when I see an application like this is the dates don't seem to be consistent with some of the laws and some of the benchmarks we had used before, whether that was a 2019 full-time equivalent or a 2020 full-time equivalent, then compared to your covered period full-time equivalent. It kind of seems to muddy the waters a little bit there. And the other thing I don't like as a tax person in general is when they say business activity, that's not defined. And so I don't know what that would mean. To me, it kind of puts you in that subjectivity category. Now, that being said, I'm not sure if Sarah mentioned it this week. I know she mentioned it last week, that if your loan is below $2 million, you meet the safe harbor certification that your loan was necessary, but the SBA could review your paperwork and review your forgiveness application at some point. But to me, I'm not sure what it means by maintaining business activity. So it's something that I guess you'll know it when you see it. But if for some reason your decline was related, your business activity decline was related to CDC guidance, OSHA, or the HHS programs or restrictions on working, that would essentially allow you this exception to a full-time equivalent reduction. So, Sarah, anything you would add to that? No,
I agree. It's subjective, and I'll talk a little bit about what's included in the full loan forgiveness application. And I agree that both applications seem to have some inconsistencies in the dates that they're using. I was going through the original revised loan application today, and I think there may even be a couple of maybe accidental errors, although I also think that they are updating almost as we speak some of these things, because every now and again you go into it and it says access denied. And then when you click back into the application, all of a sudden you can't find the error that you had noticed earlier. So I think they're catching some of these things as they go.
To me, I think the key thing to look for the EZ form is it may make the process easier with your bank. So if you can fall to that EZ form and the simple math formula it has in there, you should really be looking to see if you can qualify for this application. The main thing is you're still likely to have to use that June, even though it doesn't mention it in the instructions, you're still likely to have to use that June 30th safe harbor to offer people their jobs back, whether they decline or accept. That will be the determination if you fully qualify for not having reductions in full-time equivalents. So you more than likely got to wait till that June 30th benchmark anyhow. And then if you at 100%, this is probably the form for you. If you have a situation where you can't achieve 100%, you may have to use the full application and may be subject to some reduction based on the actual decline in FTEs.
Okay. So if we talk about the original revised loan forgiveness application, what this new loan application did is it did update for the 24-week period. Now, if we remember in the PPFA, you had, the covered period has been extended 24 weeks, but you can elect an 8-week covered period if you so choose. If you applied for your loan or you received your loan before June 5th, which was the date the PPPFA was enacted. Looking at the application, we got a lot of questions last week that said, well, I'm going to be able to maximize, use 100% of my PPP funds, qualified expenses in 10 weeks. Can I apply in 10 weeks? And I think the answer to that question is no, because when you look at the definitions of covered period and what's required, you must meet the FTE, the average FTE rule, right? So we remember back you have to keep the same amount of FTEs during your covered period as your reference period, whichever reference period you chose. So if you're going to elect the covered period for 24 weeks, then you need to have those FTEs for that full 24 weeks, or go to the safe harbor period, or the safe harbor date, which under the 24-week period is going to be December 31st, 2020. So I don't think that you'll be in a position where you can just apply for loan forgiveness somewhere in the middle, because you won't be able to support that FTE number that you need to have to achieve full forgiveness. Similar on the compensation reduction, right? You have to, if you've reduced compensation by 25, you have to prove that you didn't reduce compensation by 25% or by more than 25%. And if you did, you must reinstate that compensation by December 31st, 2020. Again, that's if you elect the 24-week covered period. So last week we had this discussion where some people may choose to elect the 8-week covered period instead of the 24-week covered period because, they sort of know where they're at, right, in that 8 weeks, and they don't want to wait another 6 weeks to find out, or they don't want to sort of keep employees on if they don't need them for another 16 weeks to achieve full forgiveness. That might not be the best business decision. So I think there will be instances where borrowers will still elect that 8-week covered period because it's sort of, the known is better than the unknown. But the good news is that you have 10 weeks to apply for forgiveness. So, you think you're going to elect the 8-week covered period, see how business goes, and maybe in the end, the 24-week covered period is okay. In that instance, you do need to be okay with waiting 16 weeks to apply for loan forgiveness than what you might if you already just made the decision today to elect the 8-week covered period. In the loan application or in the forgiveness application too, we've talked about this the last few weeks. There, the language amounts paid or incurred. And, I sort of had alluded to this in the past and said, well, I think that you may be in a position that you could potentially end up getting 10 weeks in your initial 8-week covered period if the timing of your loan disbursement was perfect. If you got your loan dispersed on April 8th and you had a payroll run on April 10th, you may be in, the language paid or incurred seems to indicate that you would be able to take the amount paid on April 10th because that amount paid is during your covered period. And then we already know, based on the guidance that we've talked about in prior webinars, that payroll incurred during your covered period but not paid. So similar situation, your covered period, if it's 8 weeks, ends on June 12th, but your payroll run is June 15th, you would get to take payroll incurred up to June 10th. So it's sort of quasi-cash basis in that regard. You would be able to take, you don't have to run a special payroll. So in those instances, if you were fortunate to get your disbursement on just the right date compared to your payroll date, you may be in a position where you were able to take 10 weeks of payroll during your an 8-week covered period. Ben and I talked, and we both agree that that's how the language reads. And we had been concerned in the past that there's a lot of places where it talks about 56 days, and the limitations are certainly for 56 days if you have a highly compensated employee. However, I think that it seems pretty clear that you could take that paid amount on April 10th, even though that payroll wasn't incurred. And they did write the legislation, the interim rules, to reflect just that for items like rent and mortgage, or rent and utilities, as well as mortgage. So I think that I think the same would apply for compensation. And there was nothing in any of the revised guidance that leads me to believe otherwise. It did clarify that amounts paid for health insurance for self-employed individuals, general partners, or owner employees of an S corporation are considered included in compensation, and therefore are not included in amounts that you put on your application for health insurance. In other words, if you're an owner of an S corporation and you are going to elect the 8-week covered period, the maximum amount, including health insurance, that you get to take for your compensation is $15,385. Similarly, for a self-employed individual or a general partner of a partnership. It also imposes that restriction on retirement contributions made on behalf of self-employed individuals and general partners. They didn't include owner employees of S corporations and retirement contributions. So if you're an S corp owner, you would get to include your retirement contributions on that line. But if you're a general partner or a self-employed individual, you would not. They did clarify that, as we expected, that the maximum amount of payroll that you can take for employees is 24 52nds, up to the equivalent of $100,000. So I think that works out to be $46,000 and change if you elect a 24-week covered period. However, it carved out an exception for self-employed individuals, owner employees, general partners, and those folks are capped if you elect the 24-week covered period at 2.5 months, equivalent of $100,000 per year, which works out to be $20,833. Now, this will help all of those self-employed individuals who were concerned and said, hey, I got 2.5 months worth of payroll, or sort of my net profit as my maximum loan, and I'll never achieve that based on the original guidance that was offered, which was you were limited to 8 weeks of your net profit, 8 52nds. So it did lift that. Now those folks should be able to achieve maximum amount of loan forgiveness, but you do have to use the 24-week covered period. If you use the original 8-week covered period, you're still back at that $15,385 limit, unfortunately.
Hey, Sarah, just to piggyback on your healthcare limitation for the self-employed, one of the questions that you and I have talked about many times, and that is being asked here and highly ranked, and that is, have they come out with any guidance on if health insurance is considered at the gross level or after considering reimbursements or co-pays from employees?
Yeah, I think the language in the application makes it quite clear that it is net of employee compensation. So essentially you get to take the employer cost, the amount that you're really incurring as the cost, and you exclude the amount of employee contributions to the health insurance programs.
Okay, great.
So a few things that I think are still unclear. I'll throw this out there. We still don't have a clear definition of transportation costs. We've talked about this in almost every single webinar. That there's been really no new clarification guidance since May 22nd. While we've gotten new guidance, new loan application guide or forgiveness application guidance, and new interim final rules that implement the PPPFA, we haven't gotten any actual clarification guidance on some of the questions that have been hanging out there, which includes utility costs. What are transportation costs as utility costs? There was something in one of the IFRs that, was a parenthetical that said it would include things like gas for a self-employed individual's car that they have in the business, but not a ton of clarification there. Also, no clarification on, can I include my common area maintenance costs for rent? We're not sure. They haven't addressed those things. Although I think with the new, if you're going to elect the 24-week covered period, maybe those items aren't quite as important as they used to be, because you'll be able to maximize your loan forgiveness in the 24-week period without adding those things. There still is no definitive guidance. We talked about this last week on the ability to, the ability to demonstrate an inability to retain to the same level of business activity. Tim talked about this when he talked about the EASY application. There is a certification requirement in the application that says, in good faith, you aren't able to return to the same level of business activity due to COVID-19. We don't know what this means. We don't know what they're going to ask for. The loan forgiveness application says that it's documentation that you're required to keep on file, but not required to submit with the application. Includes, just why, how you were able to come to that certification that you aren't able to return to the same level of business activity. And, as Tim said, this is due to CDC restrictions, OSHA restrictions, or human health and safety guidelines. But I don't know what they're going to ask for. And sort of similar to, we had hoped that we would get some guidance on the certification for the need of the PPP application. And, this goes back to some of our first webinars, and we kept thinking we were going to get guidance on what was, what sort of documentation would you need to show for that? And that never came to fruition. I don't expect there to be a ton of guidance on this certification to come out, just based on history with the SBA and the administrator and how they've been issuing guidance here. So I think it's going to be pretty subjective. And if you feel like your business is in that situation, then I think that, you want to do the best you can to build your case. But remembering that it is pretty specific as to, CDC guidelines, OSHA guidelines, and the human health and service guidelines. I think you would be hard pressed if, and now I'm probably speaking a little bit over my knowledge here, but I don't know what the CDC says, for example, on how a manufacturing facility gets back to operations and what restrictions they have on how many employees can be in the manufacturing facility at the same time. But if in that instance there were no restrictions by either CDC, OSHA, or human health and safety, but because your capacity, because your need wasn't as strong, so you needed to let people go, I don't know that you would have the ability to make that certification, because that was just a demand issue and maybe not a COVID-19 safety issue. Tim, I don't know if you have any thoughts on that.
No, nothing more than what you said. I mean, to me, what's hard to determine is the broadness of different industries and different participants around here. And I would agree with what you said. I can't think of I don't think there's any Brightline test for what would determine somebody's certification that they are just flat out, because of these rules or inhibitors, prohibited from reaching or attaining the business level activity they had before.
Yeah, I mean, I think it would be really easy if we get to December 31st and bars, restaurants, entertainment venues are still subject to 50% capacity. That's going to be that to me seems like a pretty bright line test. You'll be able to this ability to demonstrate that you couldn't return to the same level of business activity. It's a little less clear if you're in, the event planning industry, or you hold large training events, or something professional services, which generally the event will hold a lot of people. That, to me, I'm not sure is going to be quite as clear. I don't know if any of those three government institutions, or whatever they're called, the Human Health and Safety, or CDC, or OSHA, if any of those three are actually putting clear restrictions on those types of events, or if those types of events aren't going to be happening because of the comfort level of the public, and how people are just doing business now. So I think that there's going to be a lot of subjectivity on this.
Well, and that doesn't even address, how about the insurance industry getting involved and potentially looking at astronomical premiums, or possibly even uninsurable events, because they don't want to take the risk that the risk is too high, or the exposure is too. I'm sure anything can be insured, but I can't imagine it wouldn't have some detriment to certain businesses or certain industries being able to get back to the level they were before.
Correct. But again, right, it's really dependent on the guidance from these three specific governmental agencies. And I don't think that those three governmental agencies are going to opine on insurability. So I think it's going to be subjective for some, but I think for others, it might not be quite as subjective when you actually look at the guidance that's issued by those three agencies to determine whether or not you meet this carve out. What is clear, though, is that the other exceptions are still out there, right? Like, they did write into the legislation that you don't have to, if you're rehiring somebody and you cannot rehire somebody with, in a similar position, that you don't have to. They will still count as an FTE. It doesn't have to be the exact same. Recognizing that there are businesses now that need a different skill. So they may be looking, they may have needed to lay somebody off who brought a great skill at live in-person training, and now they need somebody who can, build out a virtual training seminar or something of that nature. Two completely different skill sets. Recognizes that, you can hire somebody for a different job. It doesn't have to be the same job, and that's written into the legislation, as well as those other things that we have talked about. Voluntary resignations won't count against you. Firings for cause won't count against you. There is some relaxation in how you count those FTEs and what those FTE exceptions are. And I think it's important, there's a lot of confusion. I don't understand how this works. It doesn't make a lot of sense. When you look at the application, the FTE, the schedule where you have to put in those FTEs, you essentially add back into your FTEs all of your exceptions. So if you're, for your 8 week, I'm just going to use the 8 week covered period. If your 8 week covered period, your average FTEs, say, were 10% less than what your base reference period was, but that's because you had a firing for cause, you were unable to rehire somebody that had previously been laid off, you add those people back just on the line item where you total, it's just a full add back 1.0 for each of those people to get to what your FTE number is for purposes of determining whether or not you had a reduction. And so it makes it a little bit easier when you actually look at the application to see how that actually works. Because until I saw the application, I was also confused on how that rule was going to work. There still has been no guidance as to, to say that you have to keep these people hired for a period of time. It seems as though if they're hired on the 30th, then you're good to go. And you could, potentially lay them back off on July 1st. That seems counterintuitive to the intent, but there has been nothing to indicate that that's not the case. There's been no restriction imposed on how long you have to keep them rehired for. So, unless something comes out into the future with that sort of information, today I would say, yeah, it seems as though you can rehire them on the 30th and lay them off again on the 1st.
Well, we have some of those hypotheticals that I love. I don't know if this is a good point to interrupt you
It's a
or
great
not.
point. It's a great point.
Right. Well, I don't want to try to oversimplify this, but there are a few questions about prepaying stuff. And I think you kind of addressed the fact that you actually could probably get more than 8 weeks if you chose the 8 weeks. There are provisions that would allow someone to get more than 8 weeks, provided the payment, and I'm going to go back to that first payment that you might pay in your 8-week period covers past periods or expenses or incurred expenses that occurred before your covered period. But what's very clear is that you're not able to do prepaids. You can't go to the end of your covered period and prepay rent or utilities or anything like that. Those are considered incurred. Those are accrual basis. So you can pay your July. The exact question is, my 8-week period ends on June 28th. You could pay your July rent on June 28th, June 27th, but none of it will be incurred in June. So you can't go past the end of your covered period with prepaids.
Correct.
So just want to be clear. There were two specific questions about the ability to prepay expenses, and the rules are pretty clear that it's accrual basis at the end of your covered period, not accrual basis at the beginning of your covered period. They use the term paid. And so if you're paying some late amounts or even paying on time, but it covered days before your covered period, those would still qualify. So
Yep, I agree. No prepayments at the end, but it even goes as far to say during, you could specifically says if your covered period began on April 5th and you had yet to make your March payments, and you make your March payments in your covered period, they will count. You get to count them as expenses. It specifically says that for rent and for utilities. I don't think it does for mortgage, but I think the same would apply. And it doesn't specifically say you can for compensation, but again, it seems as though that would apply, keeping in mind that you still have, if you have highly compensated employees who make over $100,000, you're still forced with those 8-week, that 8-week limitation if you elect the 8-week covered period, or the 24-week limitation if that's the covered period you elect. So, not as helpful for your highly compensated employees potentially, but could be beneficial, especially if you're looking at it saying, I got 2.5 months worth and I didn't spend it all in the 8 weeks. If your loan was timed just so, maybe now you can get it all spent in that 8 weeks. And so you get to just go ahead and apply for loan forgiveness earlier and sort of, deal with what you know today rather than trying to determine what is the future going to look like. And do I really, am I better off today or tomorrow? And not want to pay the extra time to make that determination.
And then there's another question here that I'm frankly surprised it's not ranked higher. And I'm hoping that's because maybe everybody's kind of reached a very high level of success in being able to utilize or potentially get full forgiveness at the 8-week mark. But we've talked about this in the firm. Ben and I had a call with our prospective client the other day where the real crystal ball issue was, I'm not going to get 100% of the amount I borrowed forgiven in the 8 weeks. I can't spend it. There's a good chance I'm going to get 100% forgiveness of what I've spent in that period, but should I go further? And we've got this specific question here where somebody's going to achieve 95% use of their PPP funds and 5% unused. Should they select the 8 or 24 weeks? And I'm gonna take the reins on this first and say I think you got to think of a few things. Number one is the old bird in a hand is worth two in the bush, and so the 8-week mark, the documentation, the pins and needles you might be on, the ability to apply sooner, does that type of security or limitation on going out 24 weeks with having to document this provide maybe some solace that 5% really isn't going to give you? And if you know where you stand now, I think that might be a little bit better. I can't help but think that we either have compression in our economy where people who started later are now going to pick up the ball, so to speak, and are more able to use weeks 9 through 24, maybe because their businesses hadn't started. But those who kind of been trucking along, and if I'm at 95% usage, I'm not sure I want to go all the way. I mean, now we're talking about going into the fourth quarter. What's the potential that you wouldn't have any full-time equivalent reductions? What's the potential that you wouldn't have to have some pay cuts? And now you're looking at a December 31st safe harbor, and 6 months from now, the economy might look totally different. So I'm at that 95.5% mark. I'd have to have strong evidence that I could get the last 5%. At $2 million, what is that? 100,000? You're talking $100,000 may not be worth the potential risk. I'm curious what yours and Ben's thoughts are on this.
Yeah, I completely agree. I mean, unless I, as a business owner, unless I looked at my backlog and I said, I'm going to have no problem. I foresee no slowdown. My backlog hasn't slowed down. And, we're going to have a great year or a good enough year where we're not going to have layoffs. Then maybe I'd say, okay. But, I agree, like, where you're at today. Do you want to wait to see where you're at 16 weeks from now? And for some, maybe it's, certainly worth considering waiting that extra 4 months, right? 16 weeks is about 4 months. The extra 4 months to make the determination on what you want to do. But, all along, it seems like loan forgiveness has been, sort of like a lot of business owners have had their eye on the prize of forgiveness and managing their business to get that forgiveness. And I'd hate to see business owners continue to do that for another 4 months and feel a little bit handcuffed from making business decisions because, they still had their eyes so focused on loan forgiveness. Don't forget, you can use the 8-week covered period, and that's where you're at there. Whereas, if you continue sort of hemming and hawing about, well, we want to get loan forgiveness, but I should really lay people off because the demand isn't there. That doesn't seem like the right way to run the business.
Yeah, I certainly agree with both of you guys as well, especially since it's so close to that forgiveness piece, and that balance is, there's a decent length loan amortization on that balance. But as we've been talking, we've had this application, the new application now for only 24 hours. So we're all still kind of working through it and thinking through it. And kind of as you were talking, Sarah, I was thinking they gave us the pieces to that we can kind of choose the amounts that we want to, the dollar amounts that we want to apply for forgiveness, right? And if you look at the application, you can essentially skip if you meet that I've returned my workforce to full on or before December 31st. You skip those FTE calculations. So, for some people, I wonder if there's an opportunity to consider applying before that 24-week period runs, because you can skip those FTE calculations, presuming that you're one of those folks that's able to bring your workforce back to 100% before your 24-week period runs out. So, it's just something that to think about. I hesitate to give an answer on that, but just as we're talking through this, they might have given us some pieces there.
I guess I would wonder how they would prove that, though, in the loan forgiveness application, right? Because there's documentation requirements that shows that you came back by December 31st or June 30th if you use the 8-week cover period. If you apply before your covered period is up, how do you prove that?
Mm-hmm.
And that's sort of where I hesitate on how do you apply for loan forgiveness before you have the documentation to prove that either your FTEs were consistent for the 24-week period or you rehired by December 31st.
I agree, and it kind of piggybacks off of a couple of questions that we saw over here. And it's, what is back to full? Is it that single day on December 31st? Is it a bigger period than that? We don't really have the answers to that. But if you're looking at your 24-week period saying there's a month period where I'm confident that I'm going to be able to bring my workforce back up to full, and you apply in that period and you think the future outlook is good, there might be an opportunity there, but I certainly agree that there is some, that there would be a lot of debate around that.
I just want to remind everybody also, somebody asked a question, 17 minutes ago, I can't remember when I said it, but I did discuss that there are 2 bills within Congress addressing the ability to deduct the payroll protection program expenses that you incur that result in loan forgiveness. So I'm going to repeat myself and say, please reach out to your Congress people and make sure they understand how important that is to the true benefit of this loan program. To maximize the benefit of the loan program would be to also allow the full deduction of the expenses you incur.
Yeah, and one thing that I do want to remind people get a little bit confused and sort of tied up on the safe harbor date. The safe harbor date of either June 30th if you elect 8 weeks, or December 31st if you elect 24 weeks. That safe harbor date is sort of a fail-safe, right? If during your covered period, whether it's 8 weeks or 24 weeks, if your FTE numbers or your compensation amounts are consistent with your base period, then you don't need the fail-safe. You don't need the safe harbor date of rehiring. You can just use your numbers during your covered period. It's only when you need that safe harbor, that June 30th or that December 31st date, that date matters, right? So if during your covered period you had no reduction, you could have a reduction after your covered period and be okay, because during the full covered period you were at the numbers that you needed to be at. And I know people often get confused, and even some of our other partners, we've had these conversations time and time again, and I keep saying, wait, but go back to the covered period, because if the covered period is okay, you don't need them on the safe harbor date. And then also just reminding people that the covered period, if you elect 24 weeks, it's 24 weeks or it ends on December 31st. If your 24-week period would go past December 31st, it ends December 31st. So there's nothing that goes beyond that date.
And that's the actual date. That's really your benchmark for determining if you're safe harbored, right? I mean, if you had reductions in workforce within your 24-week covered period, and by the end of your 24-week period, people return to full employment, you're still going to have an average calculation that likely may be lower than your measurement period. So you're still working to that December 31st, 2020 restoring period or restoring date, correct?
I think so. I'd have to double check that though. I've been confused on that a time or two.
Okay. 3:57. I promised I had a couple more announcements before we go into some final questions. So as I had said earlier, everybody, we anticipate this to be our last live video discussion on the Payroll Protection Program loan, and in particular the loan forgiveness calculation. And by no means do we think we're just walking away from this. I think I had said 2 weeks ago we were up to our knees in this, and then last week I said I think we were up to our waist into it. Well, now we're up to our necks in this, and this is impacting our clients every day. So Ben, Sarah, myself, we work on this from helping clients still apply. Last week I was still helping somebody apply. I was still helping them go through a second dose of Q&A or documentation they had to supply. We are helping clients kind of identify the information they need to start gathering and help define better the forgiveness application for them. Now, as Ben said, we got less than 24 hours with the new application, so we know we're going to be working more closely with some of our clients, especially now that we see the terminology. Sometimes the terminology agrees with the law, sometimes it's a little bit different, but we're working with clients on that. We're also working with clients on forecasting cash flows. It's not just related to the PPP, but probably you're all experiencing either vendors who want to get paid faster and customers who want to pay slower. So we're still dealing with this kind of stuff every day, but what we're expecting to do from this point on, and I'll use the 2 bills that are in Congress. If we get to a point where we have some action on that, becomes a law, we would anticipate probably putting some kind of a video together, some type of a Q&A or kind of a format where the three of us get together and kind of lay out what the new rules or what the law might change. I would also expect to see more articles. I know I missed a promise. I know last week I promised an article on the accounting side of this. We'll get that out to you. So what I'm saying is we're not walking away from this. We're just not likely to be having this live webinar next Wednesday, but we'll be looking for something. We have all of your contact information. We certainly expect through Ben's help in particular, Ben's the key catalyst to this. We expect to be updating our resources on the website and as well as the links. Sarah brought up a great point. At some point, you can't get into some of the Treasury Department's documents because they're denying you access. Well, the reason they're denying you access is they're probably making changes to it. So I know we have those links. We've got some resources that help you with the calculation. For those of you who are still calculating the loan or still considering the loan, I know we have those resources. So expect to see that real-time adjusted as much as possible or as often as we need to. But so I just want to make sure I covered that. We are grateful to everyone who's participated and been involved in these from day one. We've had tremendous participation and great questions. So with that, I'm hoping you guys maybe were looking at some Q&As while I was doing my little housekeeping. I don't think I missed anything, but any last 14-minute thoughts here, Sarah?
You know, the last thing that I wanted to say is, you know, the borrowers and lenders can mutually agree to extend the terms of the loan to 5 years, but I don't think that there's a lot of incentive for banks to do that because the interest rate is only 1%. So if you're in a position where you don't think you're going to achieve full loan forgiveness, if I were you, I would certainly be talking to my banker tomorrow to find out what their temperature is about extending that loan period. Because, you know, with the new deferment rules, which are, you know, you get to defer this payments until the SBA remits the funds to the bank, you may be in a position where you're paying this loan back, not in 2 years, but in a year, you know, 12 months instead. So certainly having that open dialogue with your banker, I would get in front of that today rather than waiting a while to do that, just to see where they're at, so you can properly cash flow, right? You can plan your cash flow as needed when these payments start coming due. I think it's going to be important. And you know, we haven't had many conversations. I think like the bankers so far have not been quite certain what they're required to do, but these new interim rules that came out make it very, very clear that they do not have to give you the new 5-year expanded maturity. But they can do so if they so choose. We were expecting the interim guidance to come out with a revised interest rate on the 5-year maturity, and it didn't. It still seems as though it's 1%. So not great for the banks, even though these loans are fully backed by the SBA and the banks aren't taking any risk, but also not providing a whole lot of incentive for those borrowers that have this 2-year maturity sitting out there today.
Good. I'm seeing we're still getting questions on this cutoff, you know, the 8 weeks. I'm not sure how much more we can go into that it really is accrual basis with some modifications, which means you can't have prepaids at the end of your covered period, but you can make payments in your covered period for expenses. That means your rent. Somebody asked a question about a storage unit. I mean, if you've got a lease in place as of February 15th, 2020, that qualifies as rent. Cars, equipment, any personal property, copiers, vehicles, and as well as your facility leases. So making those payments in your covered period, you know, you really need to look at how much at the end of your covered period, how much might be considered prepaid. And you also get to make that payment for rent that's during your covered period. You get to make that payment after your covered period ends, provided that you make that payment before your next rent cycle begins. So. Yeah,
and I see a question here that asks to clarify how long you have to apply for loan forgiveness. If I said 10 weeks, I misspoke. It's 10 months. Everything else has been in weeks, so we may have misspoke on that. You have 10 months to apply for loan forgiveness.
And I think you could go even. This is the analness of reading some of this law. All the law says is that if you don't apply for forgiveness within 10 months, you have to start making payments on that day. So there is no restriction other than, I think the one restriction you do have is you can't possibly apply, I don't think, until you can meet the requirements of the information you must submit. And in many cases, for those people going the 24-week route, that's going to be December 31st. For those people going the 8-week period, that very likely is going to be June 30th. So,
or it could be today. You know, if they don't need June 30th as their safe
right.
harbor, it can be whenever their covered period ends. And I agree, it doesn't actually provide a firm deadline. It seems like it's more of an implied deadline, because if you don't apply within 10 months, your first loan payment is due on that day. You know, that the rules, the date the rules give you is, I forget exactly what it is, but it says, you know, you have 10 months would be October 13th. If you did not apply by October 13th, your first payment would be due on October 13th. So feels like an implied deadline, but it's not, certainly not explicit.
Yeah. Oh, let's see what we got here. So yeah, so this is the 10 weeks. So we just answered that question from Debbie here on the 8 weeks, or 10 weeks versus 10 months. All right.
I see a question here. Can we include rent and utilities that we pay for an employee that are in the employee's name? I don't believe so, because you need to have a service contract in the company's name to do that. Now, if you're reimbursing them an expense, I don't know, potentially, if you have a reimbursement policy for that type of expense that was in place, but they have not given a whole lot of context around any of those types of hypothetical questions. And I think the hope is now that if you elect the 24-week period, these types of details aren't going to be as important, because you should really be able to spend the money in 24 weeks without some of these other minor miscellaneous type utility costs.
Yeah. So not to put you on the spot, Sarah, but a very well-known attorney in the local community is asking a specific question, and it relates to the full-time equivalent reduction safe harbor calculation. And it's step 4, where it asks you to enter the borrower's total FTE as of the earlier, which is on page 4 of the application, by the way, using the earlier date of December 31st, 2020, or the date this application is submitted. And his question is, does that essentially make the 6/30/2020 irrelevant?
No, I don't specifically know exactly what he's asking. I'd have to go back and look. But this goes back to, if you're electing the 8-week safe harbor, then 6/30 is relevant, because that's the safe harbor date you're using. And so it says, the earlier of 12/31/20 and the date of forgiveness application is submitted. But I think you still have to go back to the rules that you're using. Are you using the 8-week covered period, or are you using the 24-week covered period? In either way, it's right. You can submit that application. You don't have to wait until December 31st. If you don't need that safe harbor, you can submit the application once your 24-week period is up. Same thing you can do on the 8-week covered period. But I don't believe that if you're using the 8-week covered period, the June 30th safe harbor goes away. But you know what? I could be wrong on that. I don't know. Ben, do you know?
No, I think you're right in that, because they just swapped out the dates in the law. So ultimately the law just moved it to December 31st for that election, I think. So I agree with you. I think that depends on your period.
So
just for the 24-week covered period, right?
So I think, to answer Tom's question, we would say, if we still have to, and we've all been through this, where instructions and things like that really ultimately aren't the law, but it's likely we don't have a version of an application for a June or an 8-week applier and an application for a 24-week applier. I feel like what we have is a 24-week applier with possibly even some squirrely language in this one, as opposed to having more of the dates that would be relevant to the 8-week applier.
Yeah, I think they rolled out this revised application, and there's some inconsistencies that I suspect will sort of get updated and not really publicly updated.
Yeah,
if you will. It'll just change in the application.
we have 6 more minutes, and I'm going to say if there's anything that's jumping out at you guys, go ahead. If there's not, I might just grab one out of here.
So I see one from Andy Schmidt. He says, to be clear, it's a potential strategy to wait maybe even up to the 24-week period and then choose what makes the most sense. It is definitely a strategy. You can definitely wait until as far as we see today, we were waiting to see if they would give us a deadline for that election, and they haven't. So you have 10 months theoretically until the end of your covered period to make the election. And certainly that 10 months wouldn't expire before your 24-week period is up. So you can wait and see what gives you the most loan forgiveness, right? What gives you the maximum amount. In fact, unless I had hesitation about keeping some, my full-time equivalents employed for 24 weeks, I would probably consider doing that to see where I got the maximum amount from.
Yeah. Ben, have you been through the application enough to know, are there ultimately shortcuts? Let's say you are going to rely 100% on the June 30th safe harbor offer of jobs. Does that nullify your need to fill in some of these other sections, or no? Do you think appliers still need to fill these sections in, understand that they may be below the 100% requirement, and then ultimately have a correction method with the safe harbor?
Yeah, so the way it works is you can essentially check if the safe harbor exception applies, and then you skip having to go through that calculation. My thought would be, if I was a borrower, I would still want to go through that calculation just to have documentation and support that, yes, this doesn't apply to me, but you don't have to provide that information to the SBA at that point.
Yeah, and I think this might be a good point to say. We, as a team, as a firm, experience different banks' protocol or requirements for information, different methodologies for applying, and we certainly would expect a similar difference with the application for forgiveness. I know some of the smaller banks in town that we ultimately utilize for some of our clients. When some of the bigger banks either were not eligible to lend out or had set thresholds that wouldn't allow our clients to apply, that some of the smaller banks stepped in. But I know some of them have hired investment bankers to kind of help with that process of digesting this documentation. So I would anticipate, kind of corroborating, Ben, your comment of, making sure you have the right documentation together, because the last thing you want to do is get caught in a pickup put down situation of submitting your application for forgiveness and having it get bounced back to you for some reason. Because I think as time goes on, there's going to be more of these applications in the system and using up man hours at all of these banks, so to speak. So. Oh, here's a potentially easy one. Is mortgage interest the only interest permitted? We have another loan that we pay monthly interest for.
Yeah, so mortgage interest includes real property mortgage, as well as if you have a specific equipment line or a loan on a piece of equipment, it would include mortgage interest on that as well. So it's mortgage interest related to real or personal property. But if you just have a line of credit that you're using to buy equipment or something else, that interest is not included, or any general note payable that is not encumbered by a piece of equipment or personal property, that interest is not included. Now, if it's a covered use, you can use the funds to pay that interest, but though that expense is not included in forgiveness. So qualified expense, but not an expense for forgiveness.
Good. Well, I see 4:14 on my clock, and I'm not going to lie and say that we're going to go further. We're going to end right at 4 really close to 4:14. We still have quite a few people online. Sarah and Ben and I will continue to try to answer some of these questions and get through most of them, hopefully. I would say look for a follow-up email with respect to the posting of the live video, as well as the questions. And we'll continue to reach out to you all with any changes or updates, whether that's with videos or articles, or as I mentioned before, Ben updating some of the resources on our website. We'll continue to make sure we get that done and don't leave anybody hanging out there. For those of you who still have some questions out there, sorry we haven't gotten to them just yet, but like I said, we do stick around, the three of us, and we'll try to answer these questions immediately. And you're welcome to stay online and see those answers. We're going to shut our microphones and our cameras off. We might chat every once in a while to clarify something, but you're all welcome to stick around and watch as those answers are typed up live, or consider reviewing when we post those later from our marketing team led by Denise Asker. So I want to. We
really appreciate everybody joining us for the last 8 weeks. You know, I know there's a lot of questions on here that are sort of hypothetical questions. You know, those are really difficult for us to answer, generally speaking, especially in the text amount. You know, it's sort of like Twitter. We're only allowed a certain amount of words in our answers here. So we'll do our best, but oftentimes these hypothetical questions, we can't give you real firm answers to. So keep that in mind. If you don't get your question answered the exact way you want it, it's pretty difficult for us when we can't, you know, exchange a dialogue about it.
Yeah, I first of all, I can't say enough great thanks, Ben, Sarah, proud of you guys. I mean, this is a lot of work, continually looking for this information, and I think you hit the nail on the head. We've never seen anything so impactful to our clients, to our practice, to our family and friends, to everybody we know is somehow impacted by this. And we certainly felt the weight of this, and I'm really, really pleased and grateful for your efforts in bringing this information to light every Wednesday. I know that Sarah and I kind of had, I don't want to say a competition, but there were times where we were both identifying as these rules and laws were updated, you know, getting on top of that and making sure we got timely information out. It was kind of fun. As painful as not having the answers are, it was kind of a joy to be a part of this process, and certainly a joy to have the two of you involved in this process. I know we've received compliments from many people out there, and I just want to say again, thank you, both of you, and for all the people behind the scenes who helped us put these together, from our living rooms, our attics, our home offices, wherever the case may be, wherever you all are. I just want to say thanks so much for the two of you, and thanks to those who participated and shared information with us. And I don't want to, as I said, please reach out to Denise Asker if there's questions that are still coming about. We've got a client base out there that might be asking or wondering the same thing. So we greatly appreciate your feedback, and we look forward to maybe what the next great thing that might come about with respect to our client base. You may see us again someday, right? And
I'm sure you will.
Yeah. Well, thanks everybody, and
everyone.
Take care.
Take care.